to start by talking about the FOMC meeting that just happened yesterday and get the high-level takeaways there. Somewhat interesting one, but also not interesting at the same time. But just going to go through a few data points here. I'm going to pull up my phone just because it was a dot plot summary of economic projections updated meeting. So there's a lot of data to get into and start to understand. So just looking at the dots here, in terms of their GDP projection, they actually downticked their projection for the March meeting for 2025 from 1.7 to 1.4%, so expecting lower growth. For the unemployment rate, for the March projection was 4.4, looking at 4.5% by the end of year. And PCE inflation, an increase again from 2.7 to 3, which comes off the back of another previous increase from the previous March meeting for the December one further. So this is an interesting situation. We're seeing growth being downticked in their forecast. We're seeing inflation ticking up higher, but at the same time, we actually didn't see any changes on their projections for Fed funds rate cutting. So most of the policy members, basically as you added them all together, when you look at the dot plots, we saw that the majority still ticked in for 2 cuts coming this year. What was interesting, however, is that yes, 10 of them had a 2 cuts by the end of the year, but there's an increase of FOMC members from 4 to 7 that were projecting no cuts by the end of this year. So lots to get into. Obviously, I didn't even mention the fact that they didn't cut rates, which shouldn't have been a surprise to anybody, but that's not what moves markets. What really moves it is obviously these dot plots and the press conference that came forth. So I want to pass it to you, Joseph, and just based on all that data, what was your read? What was your takeaways?
Well, first off, I think, like you mentioned, Felix, and that was a really good summary, what was most interesting to me was the dot plot forecast. It seems like the Fed is a bit more downbeat on the economy, revising down growth, but also seemed a little bit stagflationary, right? You're revising up inflation and you're revising up unemployment. So all in all, that seems like not good. Now, the Fed has always been saying for the past few months that they are basically just going to be late. So they're not cutting this time, and they kept their forecast from the last time. So what Powell has been telling us is that there's so many things happening in the economy. We have changes in policy, from changes in immigration policy, fiscal policy. Of course, we have changes in regulatory policy and trade policy as well. And he doesn't know what's going to happen, and so he's just going to wait to see what the data says. That's a little bit different than how he usually acts, where he tries to get ahead of it. Now remember, he cut 50 basis points right before the election last year, thinking that there was a recession, wanting to get ahead of it. But now he's committing to being late. So what that tells me is that he's really not going to do anything until we see the unemployment rate tick up. And it's been trending higher. Right now, the unemployment rate is 4.2%, but maybe, and Quinn will probably talk about this, but we see a lot of indicators in the labor market that it's softening. Powell has a different take. He seems to be very happy with 4.2%, describing as full employment. But it seems like until that ticks higher, we're not going to get rate cuts.
Yeah, I thought it was interesting when you compared March to June on the dots. Basically, the only incremental change for 2025 was that 3 people went from 1 cut to no cut, and 1 person went from 2 cuts to 1 cut. So it was, that's hawkish, and I think one cut came out of 26, I believe, or 27, in the backdrop of that revised worse economic data. And he seemed like, for one, the nearest cut is not priced until September anyways. So being 3 months out, how much does this meeting really have near-term impact on markets? Not a ton. I did think it was interesting because I think we discussed this on last week's, how in that recent labor market labor report that the unemployment rate barely stuck at 4.2, so it was like 0.005%. Very easily could have been 4.3, but also that it stayed steady for the wrong reasons, meaning declining total number of employed and lower labor force number. And so someone did ask about the immigration issues, and he noted that this dynamic where you can have a more stable unemployment rate for the reasons of not growing labor, but actually shrinking labor force. And he basically acknowledged this as being okay. It will hold the unemployment rate lower for longer, and they will not look through that to infer a weaker labor market. So on many accounts, very hawkish. It's very clear they expect at least some meaningful uptick in inflation, and even September is, I don't know how guaranteed that is at this point off theirs. I think you really need to see market weakness for them to move.
Yeah, my take is just that it feels like, it's clear that Chair Powell is just trying to get to the finish line of his term in one piece, basically. Like, I think he would have preferred if he could have just skipped the whole press conference in general and just been like, all right, we're not doing anything, and we're just going to sit there and don't talk to me until at least 2026. But he's not in a situation where he can do that, so has to go up there. And the issue is that as monetary policy cannot not do anything. By doing nothing, it's still an intentional policy choice. So just by them sitting flat as they are right now, and that they hope to do so for quite a bit of time to continue, that's still an intentional policy decision, because the economy is dynamic and it's moving all the time. And as they sit, if you just think about like a classic Taylor rule type model, if we see them stay flat at the same time that the unemployment rate ticks higher, and to your point, we were very close to 4.3%. So you have that situation, and then you have these continuous downside surprises in the inflation print. We can keep holding out and wait for the tariff inflation to show up in the CPI data. And yes, maybe the big one's coming next print, but the fact of the matter is that, core CPI month over month came in at 10 basis points. That's a huge miss. So there's a lot of services disinflation. We can talk about this some more, but there's a lot of fracturing underneath the surface of that unemployment rate in terms of the labor market. So it just feels, and I'm curious both of your thoughts on this, that by just staying flat, it's still creating an even more restrictive monetary policy stance, even though their intention is just to not do anything that goes either hawkish or dovish, but by doing nothing, they're actually being hawkish.
Yeah, so as inflation comes down, real rates go higher, right? So I think one of the points that he mentioned was that if you were backward looking at the data, you'd probably be cutting by now. Like you mentioned, labor market is softening. It could have been 4.3%. If you look at continuing employment claims, that continues to rise, right? That means the stock of the unemployed people are rising. So if you lose your job, it's harder and harder to find a new one. Now, this past week, there was also a very interesting story in the Wall Street Journal showing how new grads are having a lot of trouble finding a new job. So the unemployment rate for young people is also rising. So definitely clear weakening in the labor market. Now, inflation has been coming in softer as well. Not just CPI, like you mentioned, Phoenix, but the Fed's goal. Headline PCE came in at 2.1% year over year in April. 2.1%, 2%, that's pretty close to me, right? So the Fed is not acting in response to this data because it's telling us, like you mentioned, that we have inflation from tariffs coming down the pipeline. So in the press conference, what really struck me was that Chair Powell was like, the professional forecasters, basically the experts are telling me that inflation is coming down the pipeline from tariffs and so forth. And that's all super reasonable, but it's also not consistent with how he's behaved the past few years, right? The past few years, well, let's listen to the forecasters, that got us nowhere. And so it's like, oh, okay, let's listen to the data. Let's be data dependent. Okay, let's do that. Now that the data is like, we should cut, it's like, let's listen to the forecasters now, right? So he just wants to be hawkish.
Yeah.
He's finding reasons to be hawkish.